A Treasury auction closed with yields clearing above expectations, forcing primary dealers to absorb a larger share of the supply while foreign participation eased. The pricing adjustment was subtle, but in sovereign debt markets, subtle adjustments are signals. At the same time, gold exports were running at one of the strongest monthly paces in recent history, and the dollar was weakening against currencies that once moved in lockstep with it. Scott Bessent was on Capitol Hill defending the durability of the U.S. financial system. Yet capital was already reallocating across asset classes, responding not to speeches but to spreads, hedging costs, and relative returns. The shift did not announce itself loudly. It registered in yields, in flows, and in where global reserves were quietly migrating. Over the past month, demand for U.S. bonds has weakened in a way that cannot be dismissed as noise. The absolute dollar amount of foreign holdings may still look large, but the percentage share is shrinking as issuance explodes. You cannot finance trillion-dollar deficits forever if the marginal buyer is pulling away. In 2025, the largest foreign buyers of U.S. debt still come from the G7. Japan, Canada, and the United Kingdom dominate the list. But that shield is thinning. Canada is steadily reducing its economic dependence on the United States amid escalating trade tension. Japan is fighting currency instability. If the yen weakens further, Tokyo may become a net seller just to defend its own system. If Japan must choose between stabilizing the yen and supporting Washington's bond market, the decision is mechanical. That leaves the United Kingdom increasingly isolated as the last consistent pillar. Outside that circle, the fastest-growing economies belong to BRICS, China, Brazil, and India. And they are not increasing exposure. They have collectively sold nearly $200 billion in U.S. Treasuries. The direction is unmistakable. And if 2025 marks the first leg down, 2026 could accelerate the shift. China's motive is strategic insulation. Beijing watched sanctions freeze Russia's reserves and moved early to reduce vulnerability. India publicly denies aggressive selling, yet reserve reductions align with rupee defense operations during the trade war. Brazil's logic is commercial. As trade with China expands and bilateral currencies are used more frequently in settlement, holding large volumes of U.S. debt becomes operationally unnecessary. At the same time, the dollar is sliding. In just 2 months, it has fallen roughly 1.5%. Over the past year, it is down more than 10%. The Nasdaq has dropped nearly 1% in that same short window. A foreign investor loses on equities and loses again on currency. A 2.5% combined hit in weeks changes allocation decisions fast. If the dollar continues to weaken, U.S. assets become toxic to foreign capital. Even a 10% rise in equities can be neutralized by a 5% currency decline. If foreign flows retreat, domestic investors become the only consistent buyers. That concentrates risk internally and fuels inflation. A weaker dollar raises import prices. Higher prices pressure policy. Policy strain feeds more weakness. Scott Bessent insists the fundamentals justify a strong dollar. He argues that regulatory certainty has returned, that 23 regulations have been cut for every new one, and that the United States remains the most attractive destination for capital. But regulation is not the fracture line. Manufacturing contraction is, well, a pressing issue. Since 2023, more than 300,000 manufacturing jobs have disappeared. The steepest declines actually followed the tariff escalation, which, is widely called Liberation Day. Input costs surged by 30 to 40% across affected categories, squeezing exporters and eroding competitiveness. Now, countries may not impose official trade barriers, but price alone, honestly, deters demand. When fewer goods are purchased, fewer dollars are required. A currency ultimately reflects productive output. If exports stagnate while imports remain elevated, adjustment comes through exchange rates. Even after recent declines, the dollar remains near multi-decade highs on a trade-weighted basis. There is still downside if trade imbalances persist. The U.S. economy is hyper-financialized. Asset prices drive perception. If asset returns weaken while the currency slides, the foreign investor case deteriorates quickly. Bond demand falls. Yields climb. Refinancing costs surge. Bessent's next defense is energy dominance. The United States produces vast amounts of crude oil and natural gas. Permits can be issued. Venezuelan heavy crude can be brought into the mix. But U.S. oil exports are roughly 10% lower than prior peaks. Heavy Venezuelan crude requires specialized refineries that not every country possesses. Meanwhile, China has expanded power generation at a staggering pace. Over 4 years, China installed more capacity than the entire U.S. grid. The United States operates around 1.3 terawatts. China approaches 3.9 terawatts. Energy fuels data centers, semiconductor fabrication, and AI clusters. Industrial scale follows power density. If energy scaling lags, technological leadership erodes. While Washington defends the dollar rhetorically, Beijing accumulates leverage materially. During congressional testimony, Bessent acknowledged that China is building alternative payment rails beyond the traditional system, but payment systems are only one layer. The deeper shift is gold. Shanghai Gold Exchange inventories have surged by 104 tons. This is separate from official central bank purchases. The People's Bank of China continues accumulating bullion. State-linked banks are buying. Military entities are buying. Commercial actors are moving global supply into domestic vaults. Goldman Sachs has suggested that China's actual gold accumulation may be significantly larger than reported, potentially up to 10 times higher than official figures. Whether exact or not, the trajectory is clear. Physical gold is flowing east at scale. Gold carries no counterparty risk. It cannot be sanctioned. It does not default. In an environment where deficits widen and currencies fluctuate, gold represents autonomy. Here is where the tension sharpens. The United States has been exporting gold at record pace. In one recent month alone, exporters shipped approximately $12.5 billion worth of physical bullion overseas. Gold rose to the top of U.S. export categories during that stretch. Shipments moved to London and Switzerland, refining hubs. From those hubs, China has been among the largest buyers. In effect, U.S. gold flows through global markets and reappears inside Chinese vaults. Instead of recycling trade surpluses into treasuries, foreign entities convert dollars into metal. Part of the trade imbalance is being settled in gold rather than bonds. Simultaneously, fiscal projections darken. By 2036, annual deficits are projected to reach $3.1 trillion. This year alone, the deficit approaches $1.9 trillion, roughly 6.7% of GDP. The breakdown reveals a deeper fracture. Interest payments consume approximately 4.6% of GDP, while the primary deficit sits near 2.1%. Borrowing increasingly pays for prior borrowing. When interest becomes the largest component, compounding accelerates. Either taxes rise, spending falls, or liquidity expands. Investors may receive principal and interest, but repayment in a devalued currency is fundamentally different from repayment in stable purchasing power. China is preparing for a different scenario. Beyond just accumulating bullion, it's acquiring upstream gold assets all over the world. A $4 billion purchase of a Canadian miner with African holdings, for example, helps secure those supply chains. Mining rights today, well, they can translate into monetary leverage tomorrow. Meanwhile, the United States officially holds roughly 8,100 tons of gold. But, there hasn't been a comprehensive audit in decades. If a global currency revaluation ever happens, mobilizing those reserves becomes absolutely critical. But if that metal has already flowed outward through commercial channels, the country's flexibility narrows quite a bit. Since 2022, demand for U.S. bonds has just sort of stagnated, even though yields have stayed elevated. Even if the Federal Reserve decides to cut rates, that alone doesn't guarantee renewed foreign appetite, especially if the dollar keeps sliding. Speeches, they just can't substitute for actual structural trade balance and fiscal restraint. Credit markets are beginning to price risk that, honestly, equity investors are still ignoring. The MOVE Index, which is Wall Street's volatility gauge for treasuries, has stayed elevated, even as headline inflation cools off. Higher bond volatility increases hedging costs for foreign institutions, and when currency hedging costs rise alongside yield volatility, the effective return on U.S. assets compresses even more. And that compression doesn't require any panic to cause rotation. Honestly, it just takes math. At the same time, Treasury issuance continues at a historic scale. The U.S. Treasury needs to refinance trillions in maturing debt over the next 12 months, all while adding new deficit funding on top. As the supply of longer-term debt increases, auctions need deeper absorption. Primary dealers can warehouse some of that paper temporarily, but their balance sheet capacity is, finite. If foreign participation thins out, yields have to rise enough to attract domestic pensions, insurers, and money market funds. But higher yields mean higher interest expense, which just reinforces the fiscal loop that's already widening. Japan's Ministry of Finance, for instance, has previously intervened in currency markets when the yen breached critical levels, and that intervention is funded by selling dollar assets. If volatility returns and the yen approaches prior stress thresholds, forced selling of treasuries becomes procedural, not political. Canada's portfolio flows have already shown episodic reduction during trade flare-ups, and the United Kingdom, while still significant, increases concentration risk when dependence narrows to fewer counterparties. So China's diversification is not confined to gold. Settlement in renminbi across energy and commodity trade corridors has expanded, and cross-border interbank payment infrastructure linked to Chinese systems now clears a growing share of transactions without routing through traditional Western rails. Each incremental shift, honestly, reduces automatic dollar recycling. Brazil's commodity trade invoicing patterns are increasingly aligning with its largest trading partner, China, rather than just defaulting to the dollar system. Meanwhile, India continues managing rupee volatility through reserve deployment. Even modest reserve shifts, can alter Treasury participation at the margin. Central banks do not need to liquidate aggressively to influence pricing. Slower accumulation alone actually changes equilibrium. Liquidity conditions also matter. Quantitative tightening has reduced the Federal Reserve's balance sheet, removing a structural buyer from the long end. If foreign demand and central bank reinvestment both soften, long-duration paper becomes more sensitive to private capital preferences. Rate cuts, if implemented, would steepen the curve, but would not guarantee stronger foreign inflows if currency expectations remain fragile. On the commodity side, bullion exports are occurring alongside record futures positioning. Physical flows toward London and Swiss refineries reflect arbitrage between U.S. vault inventories and global pricing. When metal leaves domestic warehouses and settles abroad, domestic liquidity tied to collateralized lending shifts as well. If a larger share of global bullion is stored outside U.S. jurisdiction, collateral leverage tilts geographically. Scott Bessent's argument that deregulation and capital openness will attract inflows it kind of assumes that global investors prioritize regulatory ease over currency stability. Donald Trump's emphasis on industrial revival, on the other hand, assumes trade balances will adjust before financing conditions tighten. But, markets will test both of these assumptions through pricing, not just speeches. If Treasury auctions require tail concessions to clear, if bid-to-cover ratios decline materially, and if gold import statistics in Asia keep trending upward while U.S. export volumes remain elevated, then the structural story becomes measurable rather than just theoretical. None of these shifts actually require a collapse. They just need incremental preference changes by large allocators. Reserve currency status doesn't disappear overnight. It erodes at the edges first, through settlement choices, collateral positioning, portfolio weighting, and hedging behavior. Each adjustment is rational in isolation, but when you add them up, they really do redefine the center of gravity. The recalibration isn't ideological, it's numerical. Auctions still clear. The dollar, it remains dominant. But, dominance can erode incrementally before it shifts in a big way. When foreign investors hesitate, when gold flows eastward, when debt service swells, equilibrium tilts quietly. The next bond auction will show who steps forward. The next gold shipment will reveal where confidence is migrating. And honestly, each movement will answer the question beneath the surface. In what asset does the world ultimately want to be paid?